Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our econ show. There's going to be a lot of things to talk about given some of the data that's come out and some of the different issues. And we're going to break it up into our normal 5 segments. And there's a lot of charts, so I'll try to go through them as quickly as possible, especially in the third segment. So when we look at it globally, stagflation is really starting to hit the global markets, but that's an easy thing to say. Yeah, I could sit here and say, oh, well, CNBC said stagflation is hitting global markets. And it's like, okay, well, that's adorable, but why? Where is it hitting? Why is it hitting? How long is it going to stay? And those are things that we want to look at when we're looking at the different drivers of some of the price headwinds, price tailwinds. Where do we see some of those key pieces? Then when we look in the U.S., we want to look at the leading indicators and why it's showing kind of that sloppy Q2. Because there's some bright spots, for sure. There's some bright spots, and there's also some real weakness. But some of the weaker ones are more forward-looking. So it just means that, which is what we've been saying, is that Q2 is going to have growth. It's Q3 that we're the most concerned about, but we want to talk about where are the cracks, where aren't the cracks, but some could be forming. And then in segment 3, which kind of fits into this, is how the consumer's really weakening and why. Where are they weakening? Why are they weakening? And how the housing market cracks continue to widen. And we started talking about some of the issues in the housing market about 2 to 3 months ago, and people thought we were crazy, and here we are. Now they are starting to show up. They are starting to become a bit bigger. And the biggest piece for us was rates, because we've always been very much on the side of rates were going to go up, which is going to pull a lot of these MBS and mortgage rates higher. The ECB is starting to shift their stance. Now, Lagarde essentially said, but for all intents and purposes, is that they're going to increase rates by about 0.5%, so 50 basis points. And that's, again, just because the data that's coming out is just horrendous when you look at inflation cost, and they are going to try to get in front of that. And then when you look at China, we want to talk about, because they've issued this new goal on stimulus, but the problem is that the data is so bad. And this is the data they actually release is bad. And the ones that they claim is, so if they're saying it's this, how bad is it actually? And this is all coming on the back of the fear that Beijing lockdowns are going to happen. So again, a lot of things to try to cover, and we'll try to get through it as quickly and efficiently as possible. So here, when we start looking at I thought this was a really good slide from the Financial Times, because it's talking about the shifts in globalization and how things are really starting to adjust. So when you look at the corporate deglobalization, which is just nearshoring, onshoring, reshoring, and again, not to belabor the point, but back in 2005 and 2006, I did a dissertation on this in school and in college, and my view was that globalization, it comes full circle. And it started in earnest, and if you start looking at the end of the 60s and as you got into the 70s, and it really accelerated through the 80s, 90s, and then obviously went parabolic with the last decade being, obviously 10 years, that last decade being that, on-time delivery, asset-light views in terms of having as little inventory as possible. Now you're coming full circle. And so when I did the dissertation, my view was that this was going to start in 2016. Instead, I was early, but again, COVID was the impetus to see, okay, well, why are supply chains so stretched? How do we insulate ourselves from some of these pieces? And that's where I think Mexico becomes a bigger winner in terms of, again, that nearshoring. We have BMW, Ford, Pirelli, a lot of different manufacturers going into that area, Whirlpool, Sherwin-Williams. That's becoming the bigger driver because you're close. You still have access to different pieces. Latin America, same thing. And that's where you're getting this pivot. Now, we do expect more to leave from China. I know Apple came out and announced that they want to increase their production outside of China. And one of the things that we think is going to be a big spot for that will be Vietnam and some other ASEAN nations, but you still need a very big grid, if you will, because a lot of these processes in terms of chip manufacturing, assembly require a lot of electricity, which is going to be one of the bigger pushes. So again, this is something that is increasing in nature, and we do expect to see more and more CapEx getting pushed towards this way. So then when we start looking at the growth and inflation steadying, so when you start looking at GDP kind of forecasts and the CPI side, that's when you start to see some of the stagflationary pressures, because growth isn't really there. You're starting to see a lot of pressure. There's a lot of reasons why it's going to go negative over the next few quarters on a global level. So when we look at the global backdrop of inflation, there's a lot of reasons why you're going to see that continue to creep up. But again, push that divide, that shift, is where you start to get to this terminal level, and that's where you start to get that pressure, because on the inflation side, you have demand where people are like, look, I can't afford that. I can't afford that price. I'm not buying it. And then that's the company is going to have rising inventories. They're not going to be able to push through cost as much. Then that's where you're going to start to see some of those slowdowns. Now, the stagflation piece of where that prices are is their costs still are going up. When you look at wages, when you look at supply chain, when you look at commodities. So that's where you get this kind of ugliness where you're going to stop seeing it go up, but you're really not going to see a lot of that softness even as demand continues to diminish. So that's why when you look at the stagflation view, the expectations are the highest since August of 2008, and we all know what happened at the end of 2008. So again, this is where we're seeing some of these different trends and some of these different views. So in 2008, the end of 2008, you had a big, gigantic drop off in demand, and that really led to this big drop. But this is a little bit different this time. When you start looking at what we have right now in terms of pricing, in terms of commodities, in terms of food, and that's where you're getting a little bit more of that pressure. Like you look at the LME, for an example. I mean, we have some of the lowest inventories going back to 1997. So even if you get that demand crunch, it's like, well, the supply still isn't there. The supply isn't the same way, again, leading to a bit more stickiness in the stagflation side, which is going to come more like the 70s and less like the late 2000s. And here's part of the reason why. Because again, I've shown this before. This is the updated version. Real wages are falling in most countries. So when you look at real wages, they continue to come down. They continue to come under pressure. And this is, again, coming back down to what can the companies afford to pay and what are people willing to leave their jobs for. So we had a chart 2 weeks ago saying that most people left their job for a 5 to 11% increase in pay. But when you look at inflation at almost 9%, depending on what country you're in, well, even if you left your job for a pay bump, you still didn't cover that. Some did. Again, depends on where you are, and that's where you're seeing some of that pressure. But then you take it to the next step on discretionary income, and when you take that, the annual percent change, you're net negative and getting worse. And that's where when you look at discretionary income, when you look at spending, that's the pressure. You're starting to see it really hit now. Before, you saw cracks. You saw little pieces. We've been talking about this since about August, where we thought August was going to be a good month for retail sales and the consumer. September was going to be soft. October was going to be great. And then November was going to kick off the slowdown. Instead, we had August, September, October really strong. September was where we were wrong, but then November really started to bite and it only progressively got worse. And here is why we think it's going to continue. And it's not just in the US. When you look at the inflation outlook and the pressure that's coming through, and when you start looking at what China's trying to do, we expect inflation to continue to pick back up because the spread between CPI and PPI is so broad that eventually you're going to have to pass some of that through, which is why it's really a global problem. And a lot of these countries that are seeing elevated inflation are exporters. The U.S. is the largest importer, which just means we will be importing a lot of these pressure points. So now when we look at the inflation side, it's all comes down to, or a big part of it also comes down to what is happening on the water. And that's when you start looking at obviously Shanghai, China in general. So as the lockdowns, slowly easing, things are starting to get better. Cases recede, the number of container ships in Shanghai, Ningbo, Zhoushan region still 11% above last year's median. And remember, last year was still elevated. And that's where you're starting to see the pressure. And as you get some of these, there was so many containers and ships just waiting that created knock-on effects, because if people couldn't get into port, they would go to some of the other ports. And again, this is going to continue to see that bottleneck, which, and if you're looking at the U.S., is going to continue to be a problem well into July. And that's when you start looking at the leading indicators. So when you look at the share of OECD, so when you look at OECD nations and leading indicators, the slowdown is getting worse. So when you look at the slowdown getting there, expansion is flatlining, downturn, you're getting a lot of these pressure points. So the pickup in slowdowns, the share of OECD countries with leading indicators in slowdown mode is increasing. And that's when you start to look at, okay, well, if the OECD markets, which are typically the developed world, are not buying products, well, then what happens to the supply chain? How does that cascade down? And that's when we look at emerging markets. We continue to see the pressure on the emerging market world as their inflation continues to bump up, as the pressures continue to mount. And this is where you have that cascading effect starting at the OECD nations and moving down. And looking at this from a different level, when you look at the last data point, again, taking those leading indicators and look at consumer confidence. Consumer confidence on the global OECD level is the only time it was worse was in 2008. This is lower than the 2011 European financial crisis. This is worse than the COVID crisis. So things continue to deteriorate. And if the consumer has no confidence in what is happening, that's when they start to tighten up. That's when they start to slow down spending. And this is where it's going to continue to get worse. You can see the cracks were there. And that's what we were talking about. We saw the cracks. We've been trying to be that leading indicator. And here we are with things continuing to struggle. And then when you look at the Citigroup Economic Surprise Index for the G10 countries, the economic surprises are getting worse, which means that they're missing estimates. They're more negative or less positive than what they were. And then you can see with emerging markets, it is also getting worse. And again, this is that deterioration we continue to see in that underlying market. All the while, when you start looking at inflation, the inflation pressures are picking up in those emerging markets. And especially in India, where when you look, it took out the 2020, 21 highs, and we expect more pressure to the upside. Some of these countries are starting to tackle this. They're cutting fees, they're cutting tariffs, they're doing a lot of these different pieces. But again, it's still not going to be enough because their underlying costs are going up. They've been trying to keep it at the factory gate, not pass it to the consumer, but that is going to continue to be a problem to keep it, which is why we expect more of those pricing pressures to flow down. And then when you look at the U.S. and the China side, so China, which typically leads the U.S., you can see it's a little imperfect, but fairly moving in the same direction, and how that's going to continue to draw down the U.S. ISM and where those pressure points are going to be. And then when you come out a bit further and you look at global U.S. manufacturing PMI, U.S. manufacturing PMI was expected to be at 57.7, came in at 57.5. But the services was expected at 55.2, came in at 53.5 in May. So you're seeing that pressure. You're seeing the slowdown in the consumer. Manufacturing, there's some of those different pieces, and we'll go through it more in segments 2 and 3. Prices getting a bit, moving higher again. At the same time, some of the supply chain had gotten better, picking back, getting a little bit slower again, and that's only going to get worse based on the issues coming out of China, while the services side, the more consumer-facing side, continues to weaken, and we don't see that changing. So then when you start looking at all of this and say, okay, well, you had all of these markets, you had all these emerging markets that had essentially tried to stimulate. The global market increased public debt. And when you look at as you came into 2020, every single one of these lines has that big spike, because even if you were an emerging market, the world was your oyster and everybody eased, whether fiscal and monetary or just fiscal. But again, most people were fiscally stimulating, monetarily stimulating their local economies. But now what? Now you have this big surge in debt, and now you have to roll it. Now you're not only rolling what you had, but you have to roll what you increased. And then if you can't cover it, you have to issue new debt. This is just pulling that interest expense higher and increasing that underlying cost, because the public debt continues to be an underlying problem, especially when you look at emerging market, low income, and emerging markets in general. Emerging markets and low income and emerging Asia are the ones that we see the biggest problem for when you look at fears around inflation and potential currency risk. And when you start talking about currency risk, there's always been so much talk about the US dollar losing its dominance. But when you look at the fear around inflation of local currencies and you look at their needs to stabilize it, the best way to do it is to take in dollars. And the only way you can do that naturally is on your by when you export, by taking in dollars. So again, all of these exports are still trading in USD. And if you can't get enough USD from trade, then you have to go out and purchase it, which is why when we look at the share of export invoicing, there hasn't been any real shift in just what the trade is. Obviously, euro is taking a bigger piece of it, but with the pressure on the European markets, and I think what is likely going to be the euro at parity with the dollar, we'll continue to see some of that strength in USD. Now, manufacturing PMI, new export orders, when you look at the US, Eurozone, again, those are coming down. But composite input prices continue to go up. And this is that different piece. So input price indices are grinding higher, which means that more upward momentum in inflation, in trying to pass this on, while new export orders are coming down. Again, this is that stagflation where you're getting this slowdown on the economic level. You're not getting those new export orders, but you're still seeing those prices go up, starting to crest a bit. But again, this is that back and forth that is going to be that underlying issue on a global level. And here's another great one that shows that spread. And we talked about this before, the difference between agriculture and food and industrial metals. So ag is not really going anywhere. And the problem is the prices are remaining so elevated because of lack of food in silos and storage, weakness in yields because of shifting floods and droughts. The issues between Ukraine and Russia that is limiting the amount of new capacity or that floating export market. While metals index, again, this is that stagflation, the pressure that we continue to see in the market. Now, the developed and emerging government interest expense is continuing to drift up, especially when you look at the emerging economies. Back to what we were saying, because they eased, they issued new debt. Now what, as we go forward and continue to see a lot of these pressure points ahead of the market. And then again, back to some of the pressure points on India and food, cooking oil prices outpacing food inflation. Russia is a big exporter of a lot of these vegetable oils, with India being some of the biggest imports. So geography constraints on food supply are not abating. Ukraine exports more than half of the world's sunflower oil, and South America's recent drought has spelled uncertainty for soybean oil supply, adding pressure to the global food crisis. So again, that's the front end, the tip of the spear when you look at a lot of these inflationary pressures on the food side, speaking on vegetable oil. Then you take this to the next level, and let's look at the US. So let's look at winter wheat conditions, some of the worst ever. When you look at spring wheat, it's caught up, but still on a very negative trajectory. Soybean and corn have caught up, but still are not gaining pace because the rate of change is not showing a catch-up, but just trying to maintain pace with what has previously been planted, so previous years. So that's the progress that we're seeing. But wheat continues to be kind of that ugly herring, where when you look over the last however many years, I think they go back over about 100. This is the 7th worst conditions we've ever had on the wheat front, and the worst since 2011. And then if you go back, I mean, you're talking about some serious problems when you look, and this is covering the Dust Bowl to give you an idea on the problems that we're having within the U.S. itself. Now, some of the benefits that came out is China has signed an agreement with Brazil to allow imports of Brazil corn, and they were previously subject to some restrictions based on the different phytosanitary restrictions. But again, that has been waived because China needs corn. China needs food, period. And they're going to try to get as much as they can. And you get an idea of, as China attracts more, well, is Iran paying well? Who's paying well? Is Japan going to pay well? Sure. But Iran and Egypt are big pieces of this. Well, is Brazil going to prefer China as a counterpart, or Egypt? Are they going to prefer Vietnam or China? Who's going to pay the premium? And that's going to create some of these different pieces and some of the pressure points that are going to come into that market. So looking at United States spring wheat planting, just to go a bit deeper and showing the last, essentially the last 12 years or so, U.S. spring wheat planting is advancing at the slowest pace in more than 20 years and was only 49% complete as of Sunday, with the average for the date is normally 83%. So about half has been planted versus normal. So when you start looking at the pressure, how do you pick that up given there was some rain that's going to slow things down, keeping some of those different pressure points? World wheat stocks to use, wheat prices could remain elevated into 2023 if the forecast currently holds true. USDA pegs world wheat stocks to use, excluding China, at 14.9% in 22-23, the fourth lowest ever and lowest since 07-08. 14.3% was the all-time low. So again, you're still seeing a lot of these points, and that would be down from last year of 16.4%. So again, you're seeing those continuous weak years, and they started in 2018 into 19. That was when we started to say, hey, there looks to be a problem here, and we're starting to see these cracks, and now they're only picking up. Ukraine and Russia's share of global trade, when you look at the global markets, when you look at barley, when you look at maize, sunflower oil, and wheat, this just kind of, again, just reminding people on the pressure that's going to remain with such a large part of the global market, with sunflower oil between those two nations being almost 75% of the market. That, again, continues to be some of these pressure points that we're seeing in the underlying pricing pressure at this juncture. Percentage of Russian Federation and Belarus in nitrogen fertilizer imports by country. Here's where those countries export to. So you get an idea on, again, how do you replace the fertilizer side? So as you try to replace the fertilizer side, you're going to increase the pressure on pricing because people are going to have to go out and find other ways and other replacement factors, and that price is going to get pushed higher. Percentage of the Russian Federation and Belarus in potassium fertilizer imports. Again, how do you replace that? That's why you're continuing to see prices, which is, again, accelerating next year's crop pricing because farmers are so concerned about making sure they have fertilizer. They're forward buying. They're buying 2023 at elevated prices, again, locking in what their break-even cost would be even into next year. And then Russian wheat is consumed around the globe, with a large part of that, not shockingly, I guess, or not shockingly, being in Northwest Europe in general, and Africa. So Russian wheat shipments for the 21-22 season totaled 34.1 million tons this week, down 11% from the year earlier. Grain exports are down 20% to 38.5 tons compared to last year. Last week, so far this month, again, you're just seeing more and more. India cuts its wheat harvest estimates to 106.4 million tons from what was supposed to be a record 111.3. Though many traders expected to be about 100 million tons after the March heat wave. So again, 106 million tons would be the smallest crop in 3 years, and 100 the smallest in 4, which is why they have banned exports, with India being 3% of the global market. Global food production and prices. Food production has continued to come down as food prices continue to go up for all of the same reasons that we have been discussing. And this is, again, putting more and more pressure on just the availability. And the pressure, when you think about globally speaking, on an emerging market level, on a global level, most people spend 80% of their wages on food. To put that into perspective on the pain that causes internally and externally. So then when you start taking all of that and then coming back to the shipping problem, well, the average waiting hours for tankers, bulkers, and containers at Shanghai have come down, but are still at a record level. And that is comparing it to 2021. And again, that is becoming the underlying problem, because if the bulkers aren't getting through, what is it doing to food? Is food rotting there? If you can't get that bulk ship from China to the next destination, are those crops going to go bad on the coast? Are you going to get dry rot? These are some of the bigger issues. And that's what you're seeing with an increase in cost. And that's where you start looking at shippers' view of available capacity continues to get a bit better. But again, getting it to the place that needs to be continues to be a problem. And all of this is leading to less and less optimism in the market. Global growth optimism is at a new record lows. And that is going back to 1994 to give you an idea of where we sit, which is why investor risk appetite is at its lowest ever back, or I should say at the lowest point it's been since 2008, 2009, which also kind of sets up beautifully for a little bear market rally, which we have seen. So now macro indicators are holding up, but everything else is falling. So when you start looking at risk appetite is down, credit conditions are worse, macro financial conditions are getting tighter, leverage is starting to fall, which just means that those macro indicators are going to continue to come down, creating what we've been talking about on that underlying slowdown. And then when you start going into the geopolitical front, 15 NATO countries and Sweden have said that they will increase spending and spend more on defense. 5 countries will now meet NATO spending goal for the first time. And this is something that has been talked about for a very long time, but it took Russia doing what it did to get people to realize the importance of doing so. Now, with that being said, let's provide a little bit of an update on Ukraine. So this is a little bit of an older chart, but we can provide some updates in general. A lot of these advancements in terms of the Russian troop managed to expand their control south of Izium and doing through the Donets River. A lot of that has failed. Right at this point, we've seen the failure there. A lot of the river crossings have been deterred. That has caused some significant losses on the Russian side on mechanical equipment as well as bridge making equipment or forming equipment. And then when you look at Ukraine, they have held a lot of the advances that we've seen in terms of the recovery of control of Kharkiv in the northwest region and continue to push them back. And then when you look at the Ukrainian military near the Kherson, you've seen that they've pushed them back further along the coast. And there continues to be a relative stalemate at this point in time. But given the new influx of equipment, the new inflow of troops coming from west to east, we do expect to see additional gains, and this is going to become an underlying problem for Russia. And there's been more and more talk about some questionable views of Putin. And again, not that it means anything, because it doesn't mean that you're going to walk in and just off a guy. It's showing that there's a lot of frustration, and this is becoming a bigger and bigger issue. Now, something that we haven't talked about in a while, but I think is important to remember, are the differences between India and China and the problems. I shouldn't say differences, the conflict that remains between India and China. So just as a reminder, during the border crisis in 2020, when you had the Chinese troops attacking the Indian troops, China established improvised positions at key locations along the edges of its own territorial claim in the region. So what did they establish? 10 camps in the Galwan Valley, occupied critical patrol points, and forces the camps on top mountain ranges, high altitude lakes, set up new bases. So again, trying to force their way into some of this. Negotiations during the crisis itself led China to abandon a small minority of these frontline positions, but over the following 2 years, the vast majority of them developed into permanent all-weather military encampments, and we'll talk about that in a minute. The strength that China has rapidly developed along the borders will constrain India's ability to recover some of this Aksai Chin region, despite the public appearance that things have gotten better and there's been withdrawals. There's been an expansion, and this is where that pressure continues to be, and we don't see that really changing as we come into the spring thaw, which has already happened, and now you're starting to look across the border, and this is not something to take your eye off of. So India, of course, has not been entirely passive throughout this over the last 2 years, with the response in the Galwan Valley quite literally pushed back the Chinese efforts to establish new positions, but its risk-averse approach so far has allowed some of that digging in, but we have had some shifts. So a bit early to define, but mostly informative. It appears that the area adjacent to the Gangor airport in Tibet is seeing new developments and earthwork and a possible expansion. Again, because of its proximity to that region, it's an important one to look at. In the last 2 years, developed more military support and infrastructure as well. So this is, again, strengthening the position in a lot of these fallback regions, which then when you looked at the previous picture in terms of what was there, you can see a lot of those forward positions in terms of those boxes and how they're going to be strengthened and supported, and one of them would be an air base from Tibet. And now when you look at the bridge which would cross the Pangong Lake, which is a very important component to it, continuing monitoring the bridge construction shows the further development on site. New activity shows a larger bridge being developed parallel to the first, likely in order to support larger and heavier movements over the lake. And again, strengthening the piece, because before you had to go all the way around, but now this would strengthen the Chinese position in terms of movements, and again, trying to counter any attacks that would come from the Indian side. So again, this is a flashpoint that we don't want to let fall too far to the back burner, given what's happened in Russia and Ukraine and some of the kind of the key important geopolitical shifts that we've continued to see in general. So that's what we have for you now on the macro global side, geopolitical side, and now shifting over into what is happening in the U.S. and some of the leading indicators.